Hi, welcome back. In this session, I'd like to revisit what I think of as an old friend. As many of you watch my YouTube videos or read my posts know, I value Tesla multiple times over the last 8 years. My first valuation of Tesla was in 2013, and pretty much every year since, I've revisited the company. My most recent valuation of the company was in January 2020, and I'll come back and talk about it. But a lot has happened since then, right? To begin with, we had the virus, upended our lives, upended economies. We've had the company itself, Tesla, reporting numbers that surprised a lot of people, especially in terms of how much they were able to deliver in revenues and profits. And finally, talking about thresholds, a couple of weeks ago, Tesla's market cap crossed $1 trillion, putting them in very select company as one of the few $1 trillion market cap companies out there. So I think it's time. It's time to revisit Tesla. So let's take a trek through my personal history with Tesla. I first valued Tesla in 2013, and I valued it then as a luxury automobile company. Why? Because in 2013, Tesla was a luxury automobile. It was a car for somebody who was wealthy, who needed a second or a third car. In fact, it was almost entirely owned by people on the coast, and especially wealthy people. Of course, since then, my story for Tesla has evolved as the company has changed and as the world has changed around us. In fact, between 2014 and 18, I valued Tesla every year. And while the values that I got were different, here were some of the things that happened. Each year that I valued the company, my story for the company got bigger, which is a nice way of saying, well, I gave them bigger revenues and higher margins and made them a more valuable company. But while my values went up, the market price for the stock went up even more. And every year between 2014 and 2018, I concluded with the final notion that this was a company I liked, but it was a company I could not invest in. Now, as you look across those valuations, even though the numbers might be different, all of those valuations share some common elements. As I've seen Tesla go back and forth over the last 8 years, and as there have been distractions thrown into the mix, is it a battery company, is it an energy company? I feel more convinced than ever before that this is, at its core, an automobile company. Now that's usually bad news because this is not the greatest business to be in, the automobile business. So let me hasten to add that this is the most un-car-like car company on the face of the earth on two dimensions. The first is on profitability. While Tesla has been a money loser for much of its life, I think especially over the last 2 years, Tesla has shown that it has the capacity to be more profitable than a typical automobile company. Maybe that comes from its operating cost structure or its unconventional distribution model where it bypasses dealerships, or its capacity to augment revenues with side revenues, selling software, selling other components that can create revenues. I think it has a capacity to be more profitable than a typical car company. The second dimension where it has disrupted and changed the automobile business. Traditionally, the automobile business has been a very capital-intensive business. In fact, historically, the way car companies establish an advantage is they built huge assembly plants and let the economies of scale give them a cost advantage over the competition. Tesla has approached this business very differently, with a more flexible way of increasing capacity. And in the process, I think it's created a lower capital intensity model, and you're going to see this play out in the stories. Along the way, the company has been helped by external forces, and it's assisted in these external forces, but it's benefited from them. The first is with global warming and climate change. Governments have encouraged the shift to electric cars, and it's undeniable that in its early part of its life, at least, Tesla was helped by the subsidies and the credits that came with electric cars. The second, and this may surprise you, is the rise of ride-sharing. Companies like Uber and Didi and Lyft is saying, why does that affect Tesla? In fact, there are very few Teslas right now that are used by ride-sharing services. But one of the potentials that the ride-sharing business has opened up is potentially in the future because Tesla's success in automated driving, that if self-driven cars become a big part of the ride-sharing business, that Tesla could get a big chunk of that business. Fourth, whether we like it or not, when you talk about Tesla, Elon Musk enters the mix. Let me be quite clear, when I value most publicly traded companies, I don't explicitly talk about the management. But with Tesla, there's no choice. For all of its life, Elon Musk has been the center of almost every Tesla story, which means that it's a personality-driven company with all the good stuff and bad stuff that comes with it. On the plus side, the fact that Elon Musk is perhaps one of the greatest visionaries in the corporate world has helped Tesla. He's a visionary who can get people to believe his visions. And that's a very rare quality. On the minus side, the man is a little unpredictable. And as we've seen over Tesla's life, his impulses have sometimes gotten the better of him and have hurt the company. Net, of course, Tesla has benefited by being connected to Musk, but there is a minus. And finally, this is a company, more than any other company that I valued, draws extreme reactions. Over its lifetime, there are people who believe through its entire lifetime that this entire company is a scam and that Elon is the ultimate con man. There are, of course, the people who've sold short over the last decade on Tesla, making it one of the most targeted companies for short sales of any company in history. So they're convinced the company's worth zero. At the other extreme are people who believe that this is potentially the greatest company ever, who think that even $1 trillion is way too small a value for the company, and who think of Elon Musk as a savior. So no matter what I conclude in today's valuation, I can almost guarantee you I'm going to hear from one side or the other, and perhaps from both sides. Now, I talked about my valuation through 2018. Let me focus on my last two valuations of Tesla, because they led to actions on my part. In June of 2019, Tesla hit a rough spot, partly because of concerns about production bottlenecks and the stories about making cars in tens, and partly because of Elon Musk going off and tweeting about going private with funding secured. And as a consequence, the stock price had dropped by more than 50%. It dropped to about $180, which is about $36 in today's split adjusted terms. I valued the company then just as I had in previous years, and for the first time, I found Tesla to be undervalued. As I told you, even in the years that I found it overvalued, I've always wanted to own the company, and I got my chance in June of 2019 because it was undervalued. I bought shares in the company. And then something uncommon happened, which is the stock went on a tear. And when I said it went on a tear, it quadrupled or almost quadrupled over the next 6 months. In January 2020, the stock was up about 250% from what I'd paid, and I decided to revisit my Tesla valuation. That was my last valuation. My value expanded substantially over my June 2019 value. I valued at about $420 per share, but the stock was trading at above $600, and I sold my shares. I know you're saying, what terrible timing. We'll come back and talk about this, but that was my last valuation of the company. So let's look at what Tesla has done over the last 2 years. And to get a sense, get some perspective, I think it's good to look at Tesla from the very beginning. In this graph, I've looked at Tesla's stock price since August of 2010. Since July of 2010 all the way through November 2021. I don't even have to draw your attention to the fact that the stock price has taken off like a rocket, especially starting in about October of 2019, but accelerating through the COVID months. In fact, sometimes looking at the stock price, you miss the bigger picture of how much this company has accomplished in terms of market value. If you look at the table here, I've listed the market value every year, November 1st of each year, going back to November 2010. November 2010, Tesla was a small cap company, $2.8 billion in market cap. November 2021, the market cap was over $1 trillion. Now, if you bought shares in November 2010 and held it through November 2021, I salute you. But in the process, Elon Musk has become the richest man in the world, and he's enriched a lot of people who went along for the ride. So clearly the market has rewarded Tesla. Now, early on, what the market was doing seemed almost incomprehensible. After all, this was a company with tiny revenues and big operating losses. And for much of its lifetime, the big question that cynics have asked is, why would you attach $100 billion, a $150 billion, a $200 billion, let alone $1 trillion value to a company with $10 billion in revenues, big operating losses? In this graph, I've looked at revenues, gross income, and operating income over time at Tesla. Again, going back to 2010 on a quarterly basis. Going back to 2013 on a quarterly basis. Well, for much of its life, you're right, Tesla has been a money-losing company with small revenues. But especially in the last 2 or 3 years, it's starting to acquire substance. Substance in what sense? Well, these are quarterly revenues. And the quarterly revenues in the third quarter of 2013 approached $14 billion. Tesla is still not among the top 10 companies in terms of revenues, but clearly the revenues are building up. What's even more impressive over the last couple of years, those losses have finally turned to profits. Both gross margins and operating margins have ticked up. In fact, operating margins in the third quarter of 2013 exceeded 14%. That's an astonishing number for an automobile company. But it's laying the framework for how we're going to think about Tesla going forward. The company is clearly no longer a small company with a lot of promise and lots of losses. It's a company that's starting to acquire substance in terms of revenues and delivering on profits. Now let me focus in just on the last year and a half, the COVID months. Now, if you look at the posts I had during COVID, I looked at how COVID played out, and there were 3 things that I emphasized over and over during these posts in 2020. The first is I mentioned how unusual the 2020 crisis was relative to prior crises, 2008, 1999, or 1992. Unlike those prior crises, during COVID, risk capital stayed in the game. You're saying, what are you talking about? Venture capital money, IPOs, money invested in the riskiest stocks and bonds. They stayed in the game. Second, during 2020, while the overall market bounced back, there were winners and losers. Sectors won and sectors lost. And if you look at the sectors and companies that won, during COVID, flexible companies beat out rigid companies. Flexible in what sense? Companies with more flexible investment policies. They didn't have big, manufacturing capacity that they could not modify. Companies that had less debt, companies that did not commit themselves into big dividends did much better than companies that had rigidity on those dimensions. And third, during this crisis, again, unlike prior ones, young companies beat out old companies. Young in terms of age and in terms of where they are in the corporate life cycle benefited at the expense of more mature companies. Now think about it. Risk capital stays in the game. Flexible companies beat rigid companies. Young companies beat old companies. If you hired central casting to create the perfect winning company for COVID, you'd probably create a company like Tesla, right? Think about what Tesla brought to the game relative to its competition. It was much more flexible than its competitors. The traditional manufacturing companies were locked in by their investment decisions. Tesla had debt, but nowhere near as much debt as Volkswagen and Ford and Toyota did. Those companies often pay dividends. Tesla doesn't. It's a flexible company, a young company, a company that attracted risk capital. And is it any surprise then that Tesla emerged from COVID as a winner? In fact, there are lots of winners that came out of COVID. You can point to the obvious ones. There's Zoom, there's Peloton. I think we need to add Tesla to the mix because many of the factors in Tesla that look like weaknesses, and I'll admit I thought of them as weaknesses as well. The fact that they did makeshift manufacturing, seat of the pants financing, became strengths during COVID. Conventional manufacturing companies were handicapped by COVID. Tesla benefited. And here's how it played out in the numbers. I focused in on the quarterly numbers from 2019, third quarter, all the way through 2021. There are 9 quarters of numbers here. Focus especially on what happened in 2020 and 2021. The second quarter of 2020, as COVID kicked in, Tesla, like everybody else, saw some damage. Its revenue growth relative to the year-on-year growth was down. Its margins kind of held up there. But what it did over the rest of 2020 and 2021 reflects how much it's benefited from the crisis. Revenue growth seems to have found new life. This is a company that was starting to see revenue growth slacken off before the crisis. You see it kick into high gear. But the more impressive component of what happened in 2020 and 21 is this is a company that finally seems to have found its footing in terms of profitability. Its gross margins went up to 27% by the time you get to the third quarter of 2021, and its operating margin approached 15%. Clearly, this is an evolving story, and if I'm going to value Tesla, I need to tell the story. So let me take a step back and talk a little bit about how my story for Tesla has evolved over time. As I said, my first valuation of Tesla was in September of 2013. And I valued a luxury auto company, but I gave it luxury auto company revenues, luxury auto company margins, and I made it reinvest like an automobile company. In hindsight, you might laugh at me, but that was my original story. That gave me a value for equity of about 12 billion. At that time, the market cap was about 20 billion, and I said, stock looks overvalued to me. Now, I did repeated valuations between 2013 and 17, but let me take you to 2017. By then, my view of Tesla was, there is a tech component to Tesla. It is still an automobile company, but there's a significant tech component. And while the focus stayed on high-end automobiles, that there was at least a chance of entering the mass market auto companies. So guess what? My target revenues, so these are the revenues 10 years forth, increased from 67 to 93 billion. Bigger revenues. My margins had to slacken off because now that you were in selling to a very, very focused luxury market, the margins reflected that. Much more capable of delivering revenues for a dollar investment. That's my break from just treating as an automobile company. My value went from 12 billion to 34 billion. That's a big jump, right? Almost threefold. But the stock price also tripled. Stock stayed overvalued. In June of 2019, I valued it still as a high-end automobile company with some mass market appeal. That's a Tesla 3 effect. But I did bring in the fact, especially given what had happened in the previous few months, that this was a company with unpredictable management. In fact, I described Tesla as my corporate teenager. A company with lots of potential, where every day one man woke up and he said, what can I do today to screw it all up? Revenues went from 93 to 105 billion. My margins actually decreased because of the troubles they were facing. My value kind of plateaued at 34 billion, but the market cap had dropped to 32 billion, and I bought Tesla for the first time. January 2020, I still valued it as an auto tech company, but with many of the problems lifted. Its debt problem had gone away. Success had had its side effects. But with increasing mass market appeal and production facilities that were starting to come into play, the Shanghai plant had started producing. Revenues had expanded from 105 to 128 billion. My margins reverted back to 12%. The value I got went from 34 to 84 billion. But the stock price, or the market cap, went to 103 billion. I sold. Again, I'll come back and talk about the timing of that sale. But I'm going to go back and look at my 2013 forecast because clearly that was, if you think about it, 2013, I came up with a value of 12 billion. My target revenue was 67 billion. Looks hopelessly pessimistic. So just out of curiosity, I went in and pulled up my 2013 predicted revenues for Tesla and compared them to the actual numbers that Tesla delivered each year. So let's take an example. In year one, in my original valuation, I had predicted revenues of 2.2 billion. They delivered 2.4 billion. I expected an operating margin of minus 5.5%. They delivered minus 4.8%. But let's go forward to 2020, 2021. From my original pessimistic lowball valuation, my predicted revenues for Tesla in 2020-21 would have been about 55 billion. They actually came in at 42 billion. They actually came in about 24% less than what I predicted. I'd expected operating margin of 8.5%. They delivered 7.76%. So that's strange, right? I came up with a value of 12 billion in 2013, and the company is actually underperforming my forecast. But here's the big difference. If my 2013 valuation were playing out, Tesla would be approaching steady state. They'd be a mature company. Their best days would be behind them. But that's not where they are. In fact, it looks like they're setting up a platform for a fresh assault on the automobile business. So all I'm saying is that when you make forecasts, you are going to be wrong, but it's not clear what you're going to be wrong on until after the fact. So it's time to update my 2021 story. Let's start with revenues. As you remember, my revenues for January 2020 were about 120 billion plus. I saw Tesla as getting BMW-like in terms of size. Now what I think that COVID has clearly reoriented the market. And I think Tesla has a real chance, and you can take issue with this, at becoming the largest automobile company. Revenues of, in fact, I think it can become bigger than Toyota, Volkswagen, around 300 billion. 400 billion would give them roughly 20% of the overall market. So this is a really big story, a story where most automobiles sold will become electric cars and Tesla will have a leading market share. I could be barking up the wrong tree, but I see a potential at least for Tesla's revenues to approach 400 billion. On margins, if you look at the third quarter of 2020, and again, that's just one quarter, Tesla's margins approach 15%. Their gross margins approaching 30%. I'm going to use 16% as my pre-tax operating margin for Tesla as steady state, because I think competition will increase. That even though Tesla will have a large market share, it will not continue to have the pricing power that it has today. 16% pre-tax operating margin. I do think that one of the things Tesla has managed to do successfully is add capacity in lumps along the way, with factories in Nevada, New York, China, Germany, Texas. It's no longer just Fremont. It's a company that's managed to add capacity, spending far less on that capacity than typical automobile companies. And in fact, I think it's set up with enough capacity, at least for near-term growth. So I'm going to allow it to get $4 in revenues for every dollar of capital invested over the next few years, and then $2.67 in revenues after that, which would make them significantly more efficient in delivering revenues than any automobile company. When I valued Tesla in early 2020, I used a cost of capital of 7%. I'm going to use a 6% cost of capital. It has nothing to do with Tesla becoming safer. It's got to do with the fact that the risk-free rate is down and risk premiums have come down, and Tesla is benefiting from an overall lower price of risk in the market. Now, Elon Musk still remains the CEO and lead person in Tesla, but I might be risking dangerous backlash here, but he seems to have become much more subdued. Maybe it's just my imagination. In fact, his focus seems to be much more on the companies he's running, though he's running multiple companies. I don't know what the focus will be on any given day. But I don't see the distractions I saw 2, 3, or 4 years ago. As I said, I might be tempting fate here, but I'm less worried about Musk now than I was a year and a half ago. So let's see how this all plays out in my valuation. My end revenues, 400 billion plus, you see that my end revenues. My margins approach 16%, 6% cost of capital. The value that I get for the equity is about $700 billion. Now, and if you take out just the optionality, about $640 billion for equity in common stock. Stock's trading at over $1 trillion, at least based on my estimates of value. The stock looks overvalued. And I'm telling a really big story for the company. Now, before you are quick to jump in and tell me what I've done wrong, and I've done plenty of things wrong, Let me start off by saying, given my choice to sell Tesla when I did, which is terrible timing, in my history of undershooting on value for the company, I'm the last person you should be relying on for your Tesla judgments, if you are. So I'm sure there are people in the audience who believe Tesla is worth a lot more than what I've estimated. And you have your story for it. It could enter this business. It could be it could be in ride sharing. And it's easy to get distracted by focusing on the next big thing or the next issue. Or you could be one of those people who thinks I'm being delusional here, that I'm being misled by what happened in the last year and a half into overvaluing Tesla. Okay. Here's what I would suggest. Rather than get into a debate about whether the Tesla 3 is selling as many cars as they claim it is, or whether Tesla's accounting is defensible or indefensible, let's focus in on the end game here, which is every story you tell about Tesla, whether it's bigger than mine or smaller than mine, there are two key variables that drive Tesla's value. One is what we think it can generate as revenues in steady state. I've used 400 billion, but maybe it'll end up with the electric car market becoming like other parts of the technology market, winner take all. Maybe they can get a 30% or 40% market share, much bigger revenues. Or it could also be that I've underestimated the potential for improvements in profitability. Look at how much margins have improved in the last 18 months. Maybe they're just getting started. Maybe they'll end up with margins that no manufacturing company has seen before, but Tesla has been one of those companies that breaks all the rules. What I'm trying to say is every argument at Tesla is really an argument about what do you think the end game is going to look like in terms of revenues and margins. Every other assumption in this valuation is a side story, assumptions about reinvestment and risk. In this table, I've looked at what the value of equity will be, changing revenues 10 years out, 2032. From the 400 billion I have to $1 trillion or to 200 billion. And remember, at $1 trillion in revenues, Tesla will be doing what no company in history has ever done. That will be the biggest revenues ever seen in the company. And margins, again, I've used those 16%, but again, maybe I've just underestimated potential here, and I've used 20, 24, and 28%. I've estimated the value of equity. So for instance, with 16% margins, and a $600 billion revenue in 2032, my value for equity is $918 billion. See the shaded areas? They're the ones that exceed the existing market cap of Tesla, which on November 4th of 2021 was about $1.2 trillion. Could Tesla be worth more than $1.2 trillion? Yes. But the way you get there would have to be on rarefied ground, right? Revenues higher than any company in history, and margins higher than any manufacturing company in the past. Now, if that's your story and you've come up with a much higher value than mine, absolutely. So what I'm trying to say is, I have my story, my value, my judgment. I'm not trying to tell you what to do. And in fact, I wouldn't want to. You have to make your own choices, and perhaps your story is bigger than mine. You know what, for the last year and a half, I've heard from many of you because much of what I do is in the public domain. So I told the world, at least the part of the world that reads my blog post, which is a tiny portion of the world, that I sold my Tesla shares in January 2020. And for the last 18, 19, 20 months, every week or so, I open up my email. There'll be somebody who asks me, first commiserates with me about my bad timing, and I'm thankful for your concern about my investment performance, and then ask me, am I sorry now that I sold Tesla when I did? I'd be lying if I didn't say that for brief moments, I wonder what my portfolio would look like if I'd kept Tesla in there when it crossed $1 trillion market cap. But it's a very fleeting second thought. I don't linger there. And I'm not lying when I say I have no regrets. And here's why. I sold Tesla when I did because I found it overvalued. And I'm going to say something that I think I need to believe in investing, which is I'd rather leave money on the table and have an investment philosophy that I hold on to than make money and abandon investment philosophy. I've seen too many investors without philosophies get whipsawed. So it's true. I sold Tesla. But so what? I made enough money on Tesla that I don't look back and say, I wish I'd made even more. Because here's what's going to happen. I'm going to come back to, now I can say with almost absolute certainty, God willing, that I'll be valuing Tesla a year from now again. Why? Because things would have changed by then. And who knows, if the price drops enough, I'll be an owner of Tesla shares again. So this is just a stop in the story. It's not the end of the story. And Tesla is a company that will continue to fascinate me because it is the ultimate story stock. Thank you very much for listening, and I hope you found this session useful.